Hello viewers, welcome to my channel. UK house prices are crashing. Soaring interest rates and falling house prices have sent a chill through the property market, causing buyers to make lower offers or pull out of purchase altogether, putting entire property chains in jeopardy. Many buyers are pulling out because they simply cannot afford mortgage rates that are now hovering around their highest level since the 2008 financial crisis. The average 2-year fixed mortgage rate stood at 6.85%, while the average 5-year fixed was 6.34%. According to Moneyfacts, and despite a surprise fall in inflation rate last month, rates are predicted to stay uncomfortably high for many months to come. Lower inflation data for June probably signals the end of the upward march in mortgage rates. The mortgage rates are likely to plateau rather than fall, as the Bank of England keeps interest rate high until next summer to tame stubborn inflation. Zoopla's latest house price index shows that rising mortgage rates over the past 2 months have reduced demand for homes by 18%. Buyers are also shunning big expensive properties. Sales of 3 and 4 bedroom family homes are down 41% compared with June 2022. Hampton's estate agency reveals that in May and June, just over half of homes sold across England and Wales were sold below their asking price at an average discount of 4.4%. Richard Donnell, research director at Zoopla, says a rise in mortgage rates from 4% to 6% reduces a purchaser's buying power by up to 20% if they want to keep monthly mortgage payments unchanged. According to Zoopla, house builders accepting price discount or selling properties with reductions of 4% or £14,000 on average. Demand from house hunters is 43% lower than a year ago, but the volume of sales being agreed is just 60% lower than last year. According to the nationwide latest house price index report, Britain's house price slump deepened after a jump in borrowing cost and the threat of what's to come held back demand from potential buyers. Nationwide Building Society said its measure of prices fell 3.8% from a year ago, the most since 2009 and quicker than the 3.5% drop the previous month. The first hard data about prices for the last month indicates the 13th consecutive interest rate hikes from the Bank of England since the end of 2021 have strained the ability of consumers to pay more for properties. The market is now in its deepest slump since the global financial crisis more than a decade ago. Values based on nationwide data have fallen about 4.5% since they peaked in August and now average £260,828. Prices fell 0.2% from June to July. After 0.1% gain in previous month, the average value of a home has only fallen about 0.5% so far this year. However, economists and nationwide say that the combined pressure of higher mortgage rates and the cost of living squeeze will weigh heavily on property prices for the rest of this year. Bloomberg Economics expect house prices to register a peak rough decline of around 10%, implying they have a further 5.5% to lose. Nationwide said there were 86,000 completed housing transactions in June, which is 15% below the levels prevailing a year ago and about 10% below pre-pandemic levels. House builders have scaled back on projects anticipating fewer buyers. Building supplies company Travis Perkins reported lower revenues and a 31% drop in adjusted operating profit and significant weakness in the UK's housing sector. There is a lot of uncertainty among people looking to purchase a new home. So it's no surprise prices continue to edge down on the both a monthly and annual basis in July, and further falls in house prices are likely for the rest of 2023. Nationwide estimated that people earning the average wage and seeking a typical first-time buyer property with a 20% deposit would see monthly mortgage payment account for 43% of their take-home pay at 6% mortgage rate, up from 32% a year ago. The Bank of England has hiked rates to curb inflation, which reached a 4-decade high late last year. Economists are anticipating another quarter point on Thursday to 5.25%, which would be the highest since 2008, with rates seen approaching 6% by February. All economic activity is energy transformed, so if the energy is expensive, that drives up the cost of all other economic activity. Moreover, the HSBC has warned that tougher times ahead for British households as an increasing number of fixed mortgage deals and UK house prices are crashing as the property market suffered its worst slump since 2009. The house prices dropped at their fastest annual pace for 14 years in July, according to Nationwide. It said mortgage interest rates remain high, affordability a challenge for house buyers. Mortgage costs hits the highest level for 15 years in July as lenders grappled with inflation and uncertainty over rates set by the Bank of England. Despite the fall in house prices, higher mortgage rates mean housing affordability remains stretched. The outlook for market activity and prices depends on the trajectory of mortgage rates. This will be a function of market expectation for how much higher base rates are likely to increase to control inflation. The latest inflation reports are starting to show the effect of higher base rates feeding through into the economy. It looks less likely that Bank of England will need to raise rates as much as financial market expected to just a few weeks ago. Thanks for watching. Please consider like and subscribe my channel.